Two levers could steer trillions this week. A courtroom fight over the Fed's independence and a single earnings print from the most powerful chip maker on earth, if not the most powerful stock. Add in rising tariffs, a softening job market, and a surprise pop in the aerospace industry. And you've got the real story of how markets move now. Let's break it all down. So a quick recap on the day. Stocks drifted higher today as the recent rally broadened beyond the mega caps into the small cap space and the mid caps. The Dow Jones Industrial Average gained 0.3% and it was powered by Boeing, which was a real moneymaker today, being up 3.5% after a $36.2 billion order was announced to sell 103 planes to Korean Airlines. So that really caused the pop. The S&P 500 was up 0.4% with the aerospace strength. Beyond Boeing, there were some other aerospace names which were among the day's notable winning industries. The NASDAQ also popped 0.4%. Now, President Trump, let's talk about this guy because he yesterday announced that he says he's removing Federal Reserve Governor Lisa Cook, citing mortgage fraud allegations. Cook says the president has no authority to necessarily fire her and she won't resign. Her attorney, Abe Lowell, says that she will sue to retain her seat and stay on the Fed. The Fed says that it will abide by the courts and remains committed to its independence. Now let's talk about who Lisa Cook is. So she's on the 7-member board of governors, and that's been the case since May 2022. She's the first black woman to serve as a Fed governor. She was nominated by President Joe Biden. Her term runs to 2038. She's a voting FOMC member, and she's mainly aligned with Chair Jerome Powell as far as voting to hold rates steady this year. She's not really supporting the Fed cuts. Now, why this matters is because Trump has pressed on and on for lower rates from the Fed to boost growth here in the economy, here in the U.S., housing affordability, and reduce the debt service coverage costs for the government and consumers alike, and businesses. Can't forget about them. So replacing Cook could help him assemble a voting bloc on the board to outpower Powell and push faster rate cuts. As a scholar by the name of Peter Brown warns, if monetary policy swings with the whims of a sitting president, that's the end of the Federal Reserve's independence as we know it. Now, where we go next really just kind of depends. There's already one vacancy at the Fed because Governor Adriana Kugler resigned. Kugler resigned this month, or was that last month? I don't know, time's flying by. But Trump has nominated advisor Stephen Myron, awaiting Senate confirmation, of course, and said that he wants to switch Myron over to Cook's longer-term seat. Now, David Malpass is in the mix for the open roles, so watch this guy and what he has to say. I'm sure a lot of the eyes will be on him and the spotlights as far as what his philosophy is if he were to join the Fed. But more so about the allegations, the referral claims that Lisa Cook misrepresented occupancy as primary residence on 2 mortgages 14 days apart back in 2021. Now, why this matters is some are noting that lenders price primary residences as lower risk and you get lower rates for that purpose. Applications probe assets, liabilities, and ability to pay. Now, a little bit of context. So back in Q2 of 2025, about 1 in 116 applications showed indications of fraud, higher for purchase loans. About 1 in 106. So the federal sentencing is rare in this case, but 38 mortgage fraud offenders in 2024. Now, what Trump's saying is that he'll respect court decisions as far as what they decide to do, but Cook intends to fight and he wants her gone. Now, the impacts here that we're seeing in the stock market are pretty much muted because there wasn't really any big moves in the stock market. Longer-term treasury yields edged higher. The yield curve steepened slightly. The Wall Street Journal Dollar Index recovered earlier losses to about down 0.1%, and gold barely moved on it. A lot of people are wondering why the markets were so calm with all of this happening, and a couple of people argued that markets already moved toward rate cut expectations after Powell opened the door to easing next month at their September 17th meeting back at Jackson Hole last Friday. Saying that he's keen to get them to do something they were probably going to do anyways, leaning towards those rate cuts. But be aware of the tail risk. Evercore ISI cautions markets may be underpricing the potential rupture in the Fed's independence in the policy reaction function in 2026. Kevin Flanagan flags that a real independence shock would be a negative influence on the long end of the Treasury curve, which we're not necessarily there yet, but that's the risk case to watch out for. Now, in contrast, Stephen Gleason calls the Fed's independence a myth, while Treasury Secretary Scott Bessent says that public trust is the Fed's only real source of independence, framing the shakeup as weeding out waste, fraud, and abuse. So, what we see is a lot of people disagree on what to make out of it all, but in the short run, Powell's own shift towards cuts muffles markets' reactions to the political fight. In the long run, though, institutional credibility is a macro variable, so if independence is seen as negotiable, inflation term premia and business cycle volatility can rise. And let's just say we don't want that. But aside all of this, I think what everybody's more so focused on is Nvidia's report for earnings coming up Wednesday evening. So options market implies a up or down 6.2% one-day move post-earnings. So pretty much saying Nvidia stock will move up or down 6.2%. Heavy traded calls target this price range of $190 to about $200 strikes, plus leveraged ETP calls tied to Nvidia. Now, why this matters is while the Fed's fight simmers, positioning risk sits more so on Nvidia, which is a single print that can confirm or puncture the AI capex narrative anchoring market leadership. This is why equities could shrug at governance drama and still whip on one earnings call. And Nvidia is just such a huge player that it's big enough to just move markets regardless of what happens. So stay tuned. We'll keep on watching this. Now, as far as data we got Mid-Atlanta manufacturing from the Richmond Fed. The headline index came in at negative or -7 in August, which was, up from -20. New orders came in from -25 to -6. Employment shipments, we've seen improvement there. Prices paid, we've seen growth accelerated, notably prices received was nearly unchanged. Demand contraction is easing, but input cost pressure is reaccelerating while output prices lag, squeezing margins and keeping this inflationary impulse alive upstream, which is a tricky mix for the Fed. We also got durable goods data today. Today was a pretty busy but calm day. The headline orders came in at 2.8% month over month, which was better than the -4% expected. Civilian aircrafts -33% month over month after a huge swing in May, being up 16%, and in June down 9.4%. Transportation 1.1% month over month. So if you strip out lumpy aircraft and core capex demand, it looks pretty resilient, but volatility in planes tells you supply chains and order timing still swing headline manufacturing prints. Now let's look at the conference board's consumer confidence numbers we got for August. So headline came in from 98.7, falling down slightly to 97.4. The present situation came in down 1.6 points to 131.2. Expectations for the next 6 months came in at 74.8, down 1.2 points. And historically, anything below 80 often signals recession risk. So we're drifting further away from 80 if you see that. Now, labor views, jobs are harder to get. It rose to negative around 20%, the 8th straight deterioration we've seen. The labor market differential came in at 9.7, which is the lowest in years. And inflation mentions rising in necessities, the 12-month inflation expectations being up 6.2% after 3 months of declines. That's some good coffee. So what does this signal? As some are noting, softer labor perceptions point to a downshift in the job growth. Jeff Roach flags that the labor differential as a useful predictor of the unemployment rate. Oxford Economics Nancy Vanden Hooten: hiring is depressed, job seekers face tougher conditions, layoffs low, but initial claims rose to 235,000 the week ending August 16th. So the main downside risks have intensified, likely pushing the Fed to cut at the next meeting. It's almost pretty much guaranteed at this point, but Bank of America deposit data shows that job hopping is down 26% from 2022's peak. The big pay bump from switching has faded from what we've seen. Now the macro translation here, because we've been talking a lot of numbers. Consumers feel pinched, job finding is harder, price pressure lingers in essentials, and wage gain optionality via job switching is shrinking. So this is exactly the mix that led Powell last week to tilt towards a September cut on the labor market risk, even as tariff pressures really complicate the inflation outlook that we've been seeing. Now, speaking of tariffs, we're not done there yet. So there's India that still needs a deal made eventually, but a trade deal looks unlikely before midnight is what was revealed. So US tariffs on Indian goods doubled to 50% after 12 a.m. Eastern time on Wednesday. Now, the trigger here is that India purchases this Russian oil. This isn't like new news. We've been talking about this here on the channel, on this channel, and you could see it on the headlines on any economic news station these days. And these levies add to the existing 25% part of the reciprocal tariff actions. And India calls the energy-based tariff unfair, noting others buy Russian oil. They weren't threatened similarly. So it's not fair, Trump. Why are you singling us out? So the White House signaled that tariffs could be reduced if more lucrative access is offered, lower barriers for U.S. firms and U.S. project funding. Now, China was also threatened as well. So Trump warns a 200% tariff if export curb continues. Looks like if Beijing curb rare earth exports. So China supplies 90% of global rare earth minerals and really dominates critical minerals. So curbs have caused production delays in the for Western manufacturers, and this is due in Washington for talks with the USTR and Treasury deputies to see where we necessarily go from here. Bet it's going to be a lot of back and forth and a lot of negotiations, but we'll keep on watching that. But it doesn't end there, because Trump threatens additional tariffs and export restrictions on companies that tax and regulate U.S. tech firms like Alphabet or Google, Meta, Facebook, in other words. So the message here is that countries with digital taxes or discriminatory tech rules face retaliatory trade actions going forward. And the policy reality here is that tariffs are becoming the primary policy lever that's really impacting supply chains, input prices, corporate planning cycles. Everything's really driven by these tariffs these days. And for the Fed, tariff-driven price increases are not easily looked through. It's hard to gauge and predict what's going to happen. So if they propagate via costs and expectations, it really muffles it. So for investors, this raises the range for outcomes of how margins will turn out, capex, and valuation multiples. Now, why does any of this matter, y'all? So the Fed path versus independence in the near term, markets expect these September rate cuts. It's almost guaranteed at this point. The legal fight over Lisa Cook may be slow moving. There's going to be a lot of news on this. This will really be distracting headlines from some of the other news we've been getting. But this is a risk case, and it's pretty clear because if independence at the Fed is questioned, the long end of the curve could reprice its expectations. And it doesn't end there because Nvidia earnings is coming up. The options market is braced for a big move. Nvidia usually beats and surprises markets, but the common belief is how long will this go on? So a strong guide validates AI capex. A miss reopens concentration risks in that debate going forth. Aerospace space breadth. So Boeing's 36.2 billion order and supplier strength, along with some of these other aerospace names, show real economy momentum that's not just multiple expansion and factory orders versus prices. So the Richmond Fed shows less contraction, but prices paid and prices received really gapped, and a margin squeeze signal that can cap equity enthusiasm. Households' confidence is down, jobs are harder to find, inflation mentions are being up, job hopping pay premium is gone, all consistent with Powell's pivot towards labor risk management. Tariffs in India at 50%, a 200% threat on Chinese magnets and new tariffs tied to digital taxes. Tariff policy is broadening, not narrowing. And two clocks are ticking at once. So one is that legal battle we talked about. Can the White House reshape the Fed without shattering trust in the Federal Reserve Bank, which holds the world reserve currency, the US dollar? The other is corporate. So that'll be Nvidia. Can Nvidia keep carrying the market, which is the most important story of the day? The real economy is whispering. Orders are uneven. Factories are healing slowly. Households feel the strain, and tariffs are back at the center stage. So in weeks like this, don't just watch prices, watch the plumbing, policy credibility, supply chain costs, and the labor momentum. That's where the next leg of this market is going to be decided. See y'all soon.